Hi, I'm David Koch. This is the last in our series of 5 videos about the rise and spectacular fall of the former childcare centre operator ABC Learning. In the previous videos, we've looked at some of the reasons why the company failed, including valuation of intangible assets and goodwill, accounting irregularities, and massive unrealistic growth ambitions. In this final video, we'll take the opportunity to explore in a little more depth the lessons that can be learned from the ABC Learning experience. The first lesson ABC Learning's failure can teach us is always to recognise revenue properly. The company appears to have employed a technique whereby the funds that were used to purchase leases and childcare licences were returned in a circular fashion to ABC Learning as revenue, rather than recorded as costs. ABC Learning tried a similar technique with its employees by recording as revenue in its accounts the contracts it entered into with its own subsidiaries to provide employees. Under accounting rules, it's acceptable practice for a parent company to earn revenue in this manner, but the amounts attached to these contracts shouldn't have been recognised as revenue for the entire group because there were no new funds coming into the business. Its truer cost was also recorded in the accounts for employment contracts. But the way ABC Learning accounted for this revenue overly inflated its figures, giving the impression of growth. The second lesson is to remember to continue to focus on the core business activities even when an enterprise is going through a massive growth phase. Before ABC Learning's huge growth spurt, Chief Executive Eddie Groves was running a successful business, operating and acquiring childcare centres throughout Australia and New Zealand. But a desire to continue to grow the business saw Groves expand his operations right around the world to places like the US, UK and Singapore. Although the company never diversified away from its main childcare business, its ambitious expansion plans needed a huge commitment of the chief executive's time and energy. The end result was that neither the overseas nor the domestic operations received adequate attention, and both eventually suffered. For example, to reduce its debt in April 2008, ABC Learning was forced to sell 60% of its portfolio of childcare centres in the US for $700 million US. As a result, its shares fell 44.5 cents to $1.53, immediately wiping almost $200 million off the company's market value. Compare this to the situation in 2007 when shares were $8.62, a price that valued the company at more than $4 billion. At the same time the company was forced to sell its US assets to reduce its debt, ABC Learning recorded a loss of $280 million, signifying the failure of the overseas operation. During the meltdown of ABC Learning's US operations, there were also significant increases in costs in the Australian and New Zealand businesses. These cost increases were blamed on the chief executive of the local operations, Mr. Martin Kemp, who resigned. Groves said at the time he would be taking control of the domestic business, but the damage was already done. The third lesson is the central importance of a company's financial accounts in indicating its health. The accounts clearly reflected ABC Learning's growth and provided detail and insight into the business. But the massive increase in the share price indicated investors had preconceived positive notions of the success of the business and did not pay close attention to the detail in the company's published accounts. When read together, the income statement, cash flow statement and balance sheet show ABC Learning rapidly expanding its operations by going on a buying spree of childcare centres right around the world. The large increases in revenues, assets and liabilities can clearly be seen in the accounts and the speed and amount of the increases provided investors with valuable information that was largely overlooked by the people that bought the company's shares. Lesson 4 is the importance of sound corporate governance practices in a business. The ABC Learning experience has 2 important corporate governance lessons. One related to margin loans, the other about related party transactions. First, let's have a look at margin loans. Eddie Groves did not properly disclose that his investment in ABC Learning shares was financed largely by margin loans. Not disclosing he had borrowed money to buy shares in the business made it look like Groves was so confident in the business he was comfortable investing considerable sums of his own money in the enterprise. But the money Groves used to buy his shares was borrowed against the price of the shares, a much less risky scenario than using his own money to buy the shares. When the share price dropped, Groves, his wife and other directors were forced to sell an estimated $52 million worth of leveraged stock. This meant the price of the company's shares plummeted. If investors knew about the margin loan arrangement, they would not have been so confident in ABC Learning's directors or their story. The other corporate governance lesson involves related party transactions. ABC Learning did not appear to disclose transactions with related parties after 2006. But the question of whether these transactions were with related parties is being investigated by ASIC. For example, Queensland Maintenance Services, which was run by Groves' brother-in-law, provided work worth more than $100 million for ABC Learning in 2003 and did $74 million in work for the company in 2004. Although under accounting rules related party transactions are allowed, they should be subject to considerable scrutiny by the board. There appears to be a lack of proper disclosure of related party transactions and adequate scrutiny over these deals by the board of ABC Learning after 2005. If this is the case, then investors did not have all the facts they needed to make an informed decision when buying shares in the business. The final lesson relates to complex financial structures and transactions. There is mounting evidence to suggest ABC Learning's financial structures and transactions were overly complex, making it difficult for investors and regulators to truly understand the business. This complexity, on top of poor decision making when buying childcare licences, ineffective corporate governance and questionable accounting practices, ultimately led to the company's demise. Statements for ABC Learning just before its collapse indicated losses for the year ending June 30, 2008 would easily wipe out any profit the company ever made.
Australia's had a rich history of entrepreneurial flair and individuals in entrepreneurship. Sadly, in this case, the entrepreneurship was exhibiting itself without the appropriate levels of discipline. So what we find, and what we found before, is that these sorts of individuals actually work on such a powerful base that they influence people to do things and other professionals to do things that are not appropriate. And so only through charismatic characters do you find yourself in a set of circumstances where your asset valuations are poorly managed, your costs are growing, and that ultimately no one's asking the right questions in the organisation. And without those right questions, then those individuals tend to be left unattended. And to a great extent, there's a responsibility of those around that person as well.
And just as a footnote to this story, ASIC is currently investigating a possible breach of the related party provisions of the Corporations Act because of a particular deal. Namely, a toy company owned by Eddie Groves' wife sold ABC Learning $500,000 worth of teddy bears for it to use in its centres, and the transaction does not appear to be at arm's length. Well, it's been a pleasure taking you through the history of ABC Learning. I hope when it comes time for you to begin practicing as an accountant, you'll remember the lessons you learned here and apply them to your own practice. Good luck.